Larry Pitkowski, one stock you like at the Good Haven Fund is Hewlett-Packard. Now you like HPQ, which is the printer and the PC side. So why do you like this as opposed to the enterprise side after the split a few months ago?
You know, Greg, we made a lot of money in HP, having bought a lot of stock during the dark days after Meg took over. We don't have anything against the HP Enterprises side, which we own also. We happen to think the HPQ side, HP Inc., is a bit more interesting. It is a profit machine. It drowns in free cash flow. It's got a 4% dividend yield, trades at 7.5 times earnings. We think the business will stabilize. We like the people running it, and we think some of the recent concerns which surfaced last quarter have been way overdone by the market.
All right, and you're also a fan of Staples. This stock dropped when the government disapproved of its merger with Office Depot. So why do you want to own it now until you get some clarity on the regulatory front?
First, we think the government should have let the merger go through. The company's going to fight in court, and we'll see what happens. The odds are low, but you never know. We never counted on the deal, however, as far as our thesis on Staples. But what you have now, after the stock has come down so dramatically, is you have what is a stable business, a 5% dividend yield, trading at about 10 times earnings. Ron Sargent and the other executives have done a very able job. If on a long shot they can get the deal done, it would be amazing. And even if they can't, we think you're looking at a very cheap stock with a very well-run company without much leverage.
All right, another stock you like, which has come down quite a bit, is WPX Energy. Stock's down around 40% this year. It's in the E&P space. All the drillers have really gotten crushed this year. Why do you want to step in?
We are contrarians by nature. If you want a different result than the market over time, you have to construct a portfolio that looks different than the market. WPX is run by a wonderful new management team. They have assets which, if you look at and you value them based on some comparable transactions that have been discussed in the industry, gets you to a stock price that is multiples of where the current stock is currently trading. You had 11 insiders buy shares at more than twice the current market price over the summer. And I think in general, it's very important to try and look for areas where there's fear, where there's disinterest, and where people are running from.
And then finally, you are a fan of Walter Investment. This company is in the mortgage business. Stock's down around 20% this year. Some say it's under attack. They've done a lot of things like a poison pill to keep potential takeovers out of their sphere. So tell me why you like it.
Walter is at its heart. The core servicing business is a processing business. The stock is cheap. We think it's trading at anywhere from a low single-digit multiple. They have recently put two shareholders on the board who together own 50% of the outstanding shares. So we think they're moving in a wonderful direction from a corporate governance standpoint. The company recently repurchased a little over 5% of the outstanding shares. We think the stock is cheap. We think it is misunderstood from a standpoint of regulatory risk. And we think there's just an enormous amount of upside.
All right. Well, thanks a lot, Larry.
Thank you.
Thank you for watching The Street.